Okay, we are going to get the webinar started on Disability Insurance 101 for physicians. My name is Jay Weinberg, and I would like to thank everybody for logging on to this webinar. A brief introduction about myself. I've been in this line of work for over 20 years, and my practice is exclusively with physicians. In a given year, I lecture to somewhere around 100 or so residency, fellowship programs, and medical schools on the topics of student loans and tax filing considerations, disability insurance, home ownership, and mortgage options for physicians, life insurance, and Roth IRAs. And if you would like to block out some time to discuss your specific situation, feel free to go ahead and complete our questionnaire at www.pgy1.com, or you can scan this QR code to add me to the contacts in your cell phone or tablet. In this webinar, I am going to provide you with the necessary tools to make an informed decision when the time comes to purchase a comprehensive individual disability insurance policy. So when it comes to disability insurance, there's going to be several buzzwords or features you want to be extremely cognizant of. The first of which is what they call own occupation. Think of own occupation as the litmus test that insurance companies use to say, if something were to happen to you, would you be able or eligible to collect on the policy? If I were to show you 5 different policies from 5 different companies, they're all going to have different wording for own occupation. It's not a one size fits all. It's not like a gallon of gas where it really doesn't matter what gas station you get it from. This is specific to the policy and specific to the company. And there's several different versions of own occupation. So just because you think you have a policy that has own occupation, that just in and of itself does not fit the bill. You need to have a seasoned eye go through the own occupation with you. The highest level of own occupation is what they call medical specialty specific true own occupation. And I'll give you an example of that. Let's say you are an orthopedic surgeon, and the lion's share of your income naturally is going to come from your surgical procedures. Well, if something were to happen to you and you could not perform your surgical procedures, you would be able to collect in full on the policy and still earn a full paycheck doing whatever else you do, whether it be non-operative medicine or a different specialty within the realm of medicine, or totally something outside of the scope of medicine. But if you can't do your surgical procedures, you would be able to receive full benefits on the policy and earn a full paycheck doing whatever else you do. That's the highest level. And there's very, very few policies that have that wording within it. The lowest level, which actually is not even own occupation, it's what they refer to as any gainful occupation. And in these policies, they say if you can perform the duties of any gainful occupation, you would not be eligible to collect on the policy. We typically see any gainful occupation within group disability insurance policies. And the reason why is because when you go to work somewhere, and let's say they have 1,000 people working there, well, they're given this disability policy to everybody. And they know that they're bringing on the good, the bad, and the unhealthy. So the way that they curtail their risk is by scaling back the wording and features within their policy to make it virtually impossible to collect on those policies. So just because you go to work somewhere and they say that they're offering a group disability insurance policy, that doesn't mean it's a good policy. It just means that they are offering something. So I would always suggest to have a seasoned eye look through that policy and make sure that it is a decent policy. And more times than not, you're going to find out that the group policies are extremely scaled back. And that's one of the many reasons why you always want to have an individual policy that sits in first position. And then if they offer a group policy, that will sit in second position. While we're talking about group insurance, let's also go through some of the differences between group policies and disability policies and individual disability policies. Taxation. Typically, group policies are going to be taxable if you need to collect on them, whereas individual policies, if you pay for them with after-tax dollars, you will receive your benefits tax-free. Portability. Individual policies are going to go with you from job A to job B to job C, no matter where you are, no matter what you're doing. Whereas group policies, they're typically going to stay behind if you change jobs or employers. Contract language. We had alluded to this on the previous page, but the wording and features within group policies are typically scaled back when compared to individual policies. And the reason why is individual policies, the insurance companies know who they're aligning themselves with. Whereas in a group policy, they're covering everybody and they know that they're getting people that wouldn't be otherwise eligible to go out and get their own policy. And coverage amounts and caps, this can be a little bit misleading or confusing, and this really doesn't come into play until you are an attending physician. So let's say you're an attending physician making $500,000. We're just going to use that number because it's a round number. Let's say you're an attending physician making $500,000 and your employer says that they offer you a group policy. Well, that's great. They offer you a policy, but they're going to say this policy covers you for 60% of your income. Well, 60% of 500,000 is not bad. However, if you dig deeper into that group policy, it's really not 60% of your income. It's going to be 60% of your income with a cap of X. So that cap of X could be $5,000 or $10,000 a month. So if you think about it, if you're making $500,000, number one, the benefits would likely be taxable. So the full benefit is not what they say they're covering you for. Then there's going to be a cap of maybe $5,000 or $10,000 a month or whatever that cap might be. Oh, and in addition to that, there's a very scaled back definition for own occupation. So just because you go to work somewhere and they tell you they're offering a group disability insurance policy, it does not mean that you do not need an individual policy. It's going to be in your best interest, if possible, to have an individual policy that sits in first position, and then if they give you a group policy, have it layer behind. There's different types of disability insurance. There's short-term and long-term policies. Short-term policies typically kick in when you're out of work for a week or two, and they may pay out for 3 to 6 months. Whereas long-term policies, they typically do not kick in until you are out of work for 3 to 6 months. And assuming you can trip the litmus test of whatever that policy may be, you may be able to collect on the policy until the age of, say, 65 or 67, depending on how it's structured. Aside from own occupation, the other most important feature for resident and fellow physicians to have on their policy is what I would refer to in generic terms as the balloon option. The balloon option allows you to increase your coverage amount at a later date without having to answer any medical questions based upon whatever your health is today. So everybody knows what their health is today. Nobody can tell me what their health is going to be in 3, 5, 7, 10 years from now. So if you get a policy today and they offer you this balloon option, you're putting the insurance company on the hook to give you more coverage later without having to answer any health questions. This feature is worth its weight in gold. Now, there's different ways that insurance companies offer this feature. There's some policies where this balloon option is extremely favorable and you have the ability to do it every year and it's not use it or lose it and there's no mandatory requirements. And then there's other policies where it's let's just call it rigid to utilize this feature. Oftentimes there's mandatory paperwork that needs to be submitted every 3 years, and you have to increase as much as they tell you you have to increase, and if you don't get that paperwork submitted within the said time frame, this feature is removed from the policy. So just because they offer a balloon option doesn't mean that it is a very flexible balloon option. Insurance pricing and wording is dictated or regulated on a state-by-state basis. Many companies have the same wording and features for the lion's share of states. And then there's some states where things are scaled back or cost more, and this is not a good thing. And with many companies, these states are going to be Florida, California, Arizona, and Nevada. There might be some one-off states, depending on the company in addition to this, but the four main ones are going to be Florida, California, Arizona, and Nevada. So if you know that you're going to one of these states, it's going to be in your best interest to secure a policy prior to going there. Now, in the event you are currently in one of these states and you know that you're leaving imminently, I think it makes sense to take a look at a policy that would be for the state that you're moving to versus the state that you're currently in, and then make an informed decision. Do I want to get this now, or do I want to wait a few months and get it then? And furthermore, let's just say you've already purchased a policy in one of these states and you know that you are leaving, or you've already left. It probably makes sense to do a review of this policy to make sure that you have a very robust policy and that you're not overpaying for it, because there's a decent chance you may be able to secure a more comprehensive policy for the same or less money. Medical underwriting. When you apply for insurance, naturally the insurance companies want to know who they're aligning themselves with for the next 20 or 30 years. So they want to know about your current health, about any surgeries, family history, pre-existing medical or psychological conditions. They also want to take a look into the pharmacy database and see what prescriptions go with your name and your date of birth. This is a big one. I always tell people, please do not have friends, family members, or loved ones prescribe you medications without there being a medical file to go with it. Because when you do apply for insurance, the insurance company, they're going to see what you've been prescribed, and then they're going to look for medical records to substantiate whatever these medications were. If there's no medical records, it poses a big challenge to getting a comprehensive policy. And many insurance companies do not require medical students, residents, or fellows to get blood and urine in order to secure a policy nowadays. From time to time, we'll come across what I would refer to as no medical questions asked disability insurance policies. And there's a time and a place for these policies, and I have access to these policies in many institutions. If you have a serious pre-existing condition that would really limit your ability to get a comprehensive individual policy, that would be a terrific opportunity to take advantage of one of these options if they are available. Now, on the flip side, if you have very little going on or nothing going on with your health, it is not in your best interest to take advantage of one of these policies, because they are oftentimes scaled back in wording, features, amounts, and in some cases, there's a price increase on these policies. Financial underwriting. If you're a graduating medical student, resident, or fellow, you can likely get as much as $5,000 per month of coverage, or any amount less than that. Now, if you're on the back end of training or if you have an executed employment contract, we can likely use that to get you a higher coverage amount. some of the reasons you want to take a look at securing a policy sooner rather than later. Now, I always tell people to lock in a starter policy if they're in good health now, because if you're in favorable health now, this starter policy will include a balloon option, which is effectively putting the insurance company on the hook to give you more coverage later without having to answer any medical questions. So that's the main reason, because you know what your health is now, but you don't know what your health is going to be in the future. So why not put them on the hook for a higher coverage amount later? And next, when you get a policy as a medical student, resident, or fellow, typically, and this isn't the case 100% of the time, but it is the lion's share of the time, typically there's going to be resident discounts that are attached to the policy that will go with the policy for its duration. So certainly it behooves you to look at a policy sooner rather than later. Some of the red flags that I've come across in the disability insurance space over the past 20 years, but these some of these red flags have really come to the forefront over the past few years. So if an insurance professional shows you a one-page grid that maps out 6 different policies, you're going to want to start running fast and keep running far. These grids are littered with incorrect or misleading information. It takes an insurance company 60 pages to map out one policy. So I've yet to understand how these insurance professionals can properly and accurately map out 6 policies on a one-page grid. Furthermore, these grids are not approved sales literature by the insurance companies or the state insurance commissioners. So there's some major issues with these grids. Next, you do not want to work with an insurance professional that only represents one company. As you can see with my little picture here, it's like trying to put a square peg into a round hole. Sometimes it may fit, but other times it's not going to fit. You want to work with what they refer to as an independent broker for insurance. And that's what I am. I represent multiple companies with no ties or allegiance to any one specific company. If the cost seems too good to be true, it likely is. You don't want to, quote unquote, price shop for disability insurance, because there's a direct correlation between policy wording and policy features. So I could show you a policy that costs $80, a policy that costs $90, and a policy that costs $100 per month. And chances are that once you understand what the differences are between them, you may not necessarily purchase the one that costs $80 a month because you are uncomfortable with how that compares to the policies that may cost a little bit more money. And this bottom one has really come to the forefront over the past few years. There's several medical forums, blogs, or websites where they have many insurance professionals that advertise on them. And it has created a flea market scenario for insurance producers, because 99% of the time, we all have access to the same policies with the same pricing. So what these producers do in order to try to get the business is they end up sacrificing really important components within a policy to bring down the price, to act as if they have the best price on a specific policy. And the truth of the matter is, we all have the same price for these policies. And once you start tweaking these policies, it's going to naturally bring down the price. So I think it's important to understand that we all have the same stuff. And then you're going to want to work with an insurance professional that you feel is acting in your best interest and not trying to cut corners on a policy in order to act as if they have something that no one else has access to. when it comes to securing disability insurance, the first thing I like to look at is the financial strength of the underlying insurance companies. Because if you're 25 or 30 or 35 years old, you're likely going to have this policy for 20 or 30, maybe even 40 years. And the financial strength of an insurance company directly correlates to their ability to pay future claims. Excuse me. So with this grid, there's several companies that offer policies. And just because a company offers a policy does not mean that they have good financials. It does not mean that they have a good policy. It just means that they offer a policy. So here are the companies that offer policies. And then there's the different financial ratings agencies where they get their head into the financials of these insurance companies. And then they assign a rating to you. The one that I like to use, and they're not better or not worse, is this one down the bottom called Comdex. And the reason I like to use them is because they make it easier to understand. Many of these other companies up top here, they give you big letters, small letters, pluses, minuses. It can be a bit confusing. With Comdex, the closer you are to 100, the more financially stable you are as a company. And you can see here how these companies shake out. And I want to stress, just because you have good financials does not mean you have a good policy. Now, I worked up a generic proposal from one insurance company that I do a tremendous amount of business with. That insurance company is Guardian Berkshire, and they have an extremely robust policy for physicians. So I want to make sure you understand the moving parts that we're typically looking at for the lion's share of resident and fellow physicians when they go to secure a policy. So the first thing we take a look at is what they call own occupation. And I referred to this when we went through the PowerPoint just a few minutes ago. So own occupation is specific to the company and specific to the policy. And Guardian Berkshire has an extremely robust definition for own occupation. And I'm going to simply summarize this for you. So they say if you can't do the main duties of your occupation, you'll be able to receive benefits even if you're working in another occupation. But then they take it a step farther because that can be a little bit broad or vague in certain scenarios. So then they say, well, if you're a doctor and if more than 50% of your income comes from hands-on patient care, or if you're a doctor and if more than 50% of your income comes from surgical procedures, if you cannot provide that hands-on patient care, or if you cannot perform those surgical procedures, for the purposes of this policy, we're going to deem you to be totally disabled, which means that you would be able to collect in full on the policy, even if you stay working, whether it be in your practice or you go into another occupation, whether it be inside or outside of medicine. But if you can't do your hands-on patient care or you can't do your surgical procedures, you will be able to collect in full on the policy. And once again, this is specific to the company and it is specific to the policy. With disability insurance, 90% of claims fall into the illness category and 10% fall into the injury category. And the reason I like to go through this is because everybody's always worried, what if I get into a car crash or what if I fall off my bike? Well, chances are that, if you get into a bike accident or something, God forbid, or a car crash, these are likely injuries that will heal up within 90 days. And these policies typically do not kick in until you're out of work for more than 90 days. So that's why there's such a big skew between illness and injury. The number one cause for claims is related to back, neck, spine, and joint. And depending on what data you're looking at, it's somewhere around 30% or so of disability insurance claims. But there's plenty of other things that can keep you out of work for an extended period of time, which I'm sure you know. Now, I worked up a sample model here. This is not for any one person in particular that is on this webinar. I just want you to understand what the moving parts are within a policy. And then on an individual basis, I can customize this for you because I work with hundreds and hundreds and hundreds of physicians in a given year for disability insurance. And I customize every policy for every client. There's no one size fits all. So I just want to go through the moving parts here so you can understand what they are. So first and foremost, do not focus in on the pricing because once you start tweaking features, that's going to impact the pricing one way or another. So I just want to go through the features, the concept, and the relationship. And then on an individual basis, we can customize a policy and go through pricing that way. So when you buy a policy, you're buying a monthly coverage amount. I'm showing you $5,000 here. Now, there's not that many medical students, residents, and fellows that actually get a $5,000 policy when they start out. But I'm showing you this $5,000 because this is the maximum you can typically get unless you're on the back end of training. When you purchase disability insurance, you want to pay for it with after-tax dollars. And then, if God forbid you need to collect, the money comes in tax-free. There's the waiting period, which I had alluded to on the previous page. They call this the elimination period. This is the amount of days that you need to be out of work before the policy kicks in. Typically, we structure these as a 90-day waiting period. You could do a 30 or 60-day waiting period, but not a lot of people are doing that because it doubles the price of the policy. You could do a 180 or a 360-day waiting period, and not a lot of people are doing that either because it really doesn't bring the price down that much. So typically people are doing a 90-day elimination or a 90-day waiting period. Then there's the payout period or benefit period as they refer to it. This is the age or amount of years that the policy will pay out for in the event of a long duration claim. Typically, people are doing policies that pay out until the age of 65. You could do a policy that pays out for 2 years, 5 years, or 10 years. But if you're a 25 or 30-year-old physician, maybe that's not ideal. You could do 65, which is what most people do. You could do 67, or some companies even do the age of 70. But if you do a 67 or age 70 policy, it's going to cost more. So I'm going to say the lion's share of people do 90-day wait with an age 65 payout. But once again, we can customize this to your liking. That's what they call the base policy. Then there's the add-ons or riders, as the insurance company refers to them. Think of these as the a la carte items on a policy. There's certain ones where you absolutely want to have them, and there's other ones where I'm going to leave it up to you. So the first one's going to be an absolute must. And before we get into these features, I want everybody watching this webinar to know that these features are very, very different from company A to company B to company C, and also they can be very different within the same company. For example, Guardian Berkshire, they have 3 different levels for partial, oftentimes referred to as residual type disabilities. I'm showing you the highest level or the top tier features, because I think it's important, especially for high income physicians, to have the strongest available policy features. But I could tweak this if you want. If you want to try to save a few dollars, and we can sacrifice the integrity of some of these features, which is oftentimes what agents do, as I referred to one of the red flags of insurance producers nowadays. So this is what they call the partial or residual disability insurance rider. The vast majority of disability claims either start or end as a partial claim. And I'll give you an example. Let's say you are an orthopedic surgeon and you are making $500,000 a year and you're working 50 hours a week. And let's say, God forbid you hurt your back. You can still do orthopedic surgery. You can still do your skill set. You can still do your surgical procedures. But let's say you can't work 50 hours a week anymore because you hurt your back and you can't stand on your feet as long. So let's say you can work, say, 35 hours a week. Well, is your employer going to continue to pay you $500,000 if you drop down from say 50 hours to 35 hours? I don't think so. They're not going to pay you for patients you didn't see and procedures you didn't do. So with this particular feature on this particular policy, if you suffer a 15% loss of income, it's going to trigger a partial claim, and it's going to pay out based upon that delta. So let's say your income goes from $500,000 down to $350,000. It's going to pay out based upon that $150,000 delta. This feature is so important because I've heard that close to 80% of disability claims either start or end as a partial claim. But once again, this feature is very, very different depending on the company and the policy. On this particular policy, it has a very lenient threshold to overcome and very robust payout for a partial disability. So this is going to be a must-have. The next feature, most, but not all, residents and fellows get on their policy. They call this the cost of living adjustment, or COLA. Think of this as inflation protection. If, God forbid, you go on a disability claim that lasts for more than 1 year, it's going to increase the amount that they pay out by 3% per year to keep up with inflation. If you don't have this feature on the policy, and you go on claim, it's going to be a static or a flat line amount. So typically, younger physicians or physicians that are very early in their career get this feature because you're at your highest exposure amount the younger or earlier in your career that you are. Because if something were to happen to you at an early age, there could be 20 or 30 years ahead of you that you would need to collect on this policy. And as I'm sure you know, a loaf of bread may cost you $3 now, but it's not going to cost you $3 in 10 or 15 or 20 years. So that's why most younger physicians do have this feature on their policy. Now, you can always get rid of features later, but it's hard or impossible to add features, and it really depends on what the feature is as to what the flexibility of it is with regard to the respective insurance companies. And with Guardian, they have a 3% compound interest cost of living, and different companies structure this different ways. Sometimes it's what they call indexed, where it's really not 3%. It's somewhere between 0% and 3%, and it's tied to the CPI, which is the Consumer Price Index. And other companies have some other ways. Even Guardian They have one where you also have the ability to wait 4 years. So once again, uh, there are ways that we can tweak all of these features, which will impact the pricing one way or another. The next feature is what I referred to as the balloon option. This is the ability to increase your coverage amount at a later date without having to answer any medical questions. This is extremely important, and if the insurance company offers this to you on the policy, there's a very, very high probability you're going to want to take this feature. So there's three things I want you to understand about this specific feature in this specific policy, because every company structures this differently regarding the policy. Even Guardian has a way that we can scale back this feature. So number one, every year you have the ability to increase your benefit amount without having to answer any medical questions. And with this particular feature on this policy, it's not use it or lose it. There's no mandatory requirements. When you want to use it, you can use it, and it stays on the policy till the age of 65. I'm sorry, 55. Other companies, there are mandatory requirements, and if you don't abide by those strict requirements, the feature is going to get removed from the policy, which is not a good thing. So that's number one. Number two, when you increase your coverage amount, you need to pay more money for the policy because you're putting the insurance company on the hook for more risk. And number three, I structured this as a $5,000 starting policy with a $15,000 bump up option. In this scenario, we can use a 3 times multiple, but this is specific to the company, specific to the policy, and in some cases specific to the institution where you're training. But I structured this as a $5,000 starting policy. You can get a 3 times multiple over and above. So in this case, you can turn this policy into a $20,000 per month policy. You just can't call me up next year and be like, Jay, I'm a fellow, I'm making $70,000 this year. I want to turn my $5,000 policy into a $20,000 policy. That is not the case. The insurance company has a grid, and they say if you're making X amount of money, you can carry Y amount of disability insurance. And they take into account your income, and they also take into account group insurance in some scenarios. So I'm just going to write out some real basic numbers just to give you an understanding here. So let's say you're making $400,000 and you don't get any group insurance. You can carry, depending on the company, somewhere around $16,000 per month of disability insurance coverage. If you're making around $600,000 and you don't get any group insurance, you can carry around $20,000 a month. If you're making $1 million and you don't get any group insurance, you can carry somewhere around $28,000 a month of individual disability insurance. So I customize my policies because I want to know what you think your earnings potential is fast forward 5 or 10 years down the road. If you tell me that you're a family practice doctor, in all likelihood, you're going to be making $200,000 to $250,000. We don't need to have a policy that caps out at $28,000 or a policy that caps out at $20,000. Why pay for a feature you're not going to be able to use? So once again, it's so important to have a policy that meets whatever your goals and objectives are. The next feature is what they call the severe, or in some cases, it's what they call the catastrophic, depending on the company and depending on the state. Think of this as like a long-term care supplement on the policy. So if you can't do your job, but you're still a functional member of society, you're going to get whatever the base coverage amount is. In this case, say $5,000 per month. Now, if something were to happen to you and you are deemed irrecoverably disabled or you have a severe cognitive impairment, if that's the case, then you would get an additional X amount per month. And think of this for like unreimbursed medical expenses. A very, very small percentage of disability claims fit into this category, so I'm not going to force you on this. Like I said earlier, the lion's share of institutions have resident discounts that are attached to them. Guardian is one of the few insurance companies where, with the exception of emergency medicine, anesthesia, and pain, they will cover mental health until the age of 65. Many insurance companies limit mental health coverage to 24 months. There are some scenarios where we may be able to secure an additional discount if you are willing to have mental health limited to 24 months on your policy, and on an individual basis, we can discuss that. With some of the insurance companies, they offer three different ways to pay for a policy. And if, God forbid, you need to collect on the policy, it doesn't matter how you're paying for the policy. The policy is going to pay out in the same fashion. And this really depends upon what your cash flow is now and how long you plan on keeping the respective insurance policy. So the first way to pay for a policy is what, in generic terms, I would call the dollar option. So let's just say a policy should cost $1, you pay $1, and it's always going to be $1. You'll see here that the price goes down a little bit when you're age 55, and that's because if you have not used the future increase option on the policy, it falls off at the age of 55 on this respective policy. Now, that's oftentimes a mute point because you'll typically use your future increase option once you're an attending physician, or once you make partner, or once your needs change and you're going to want to have that higher coverage amount. So if you plan on keeping the policy for a long period of time and you have good cash flow, you're going to likely want to consider the fixed or the level premium option. The second option is what, in generic terms, I would refer to as the 50-cent option. So the insurance company says, okay, well, if you don't want to pay whatever the dollar option is, you can give us a lesser amount. In this case, say $1,300. So rather than paying $2,300, you can pay $1,300. But if you do that, it's going to go up and up and up over time. So initially, you'll pay less. But over time, assuming you hold the policy for a while, you will pay more. In this particular model, the inflection point is at the age of 50. So if you told me that your plan is to only keep this policy for, say, 10 or 15 years, and then you're going to cancel it, you'd be better off doing this second option, because when you cancel it, you will have paid in less money from a cumulative premium standpoint. The third option is what many residents and fellows do that have restricted cash flow, but realize the importance of securing a policy. And they really want to get a robust policy now, but maybe they don't have the cash flow that would allow to pay for, whatever that fixed or level price would be. So I call this third option the hybrid option. And I'll give you an example. Let's just say for the first 2 years, you pay that partial price. So rather than paying $2,300, you pay $13. Rather than paying $23, you pay $14. So in the first 2 years, you're going to save yourself $1,900 because you paid that partial premium. And then in the third year, you call me up and you say, Jay, I'm an attending now. My cash flow is fine. I'm ready to change this over to the fixed priced option. So this end column here is the fixed priced option at whatever point in time you are. So in the third year, if you change over to the fixed priced option, the cost would now be $25.83, and it would be $25.83 right on through. So what ultimately happens here is the insurance company says, okay, doctor, you just saved yourself $1,981 because over the first 2 years you paid the partial premium. How are we going to get that $1,981 back from you? So if you take a look at the delta between 2362 and 2583, let's just for round numbers call it $220. So the insurance company, they say, okay, well, you're now going to pay us $25.83, and over, it's typically an 8 or 10 year period. So over an 8 or 10 year period, we're going to now get back that $1,981. So we're going to be even Steven right around here. And then effectively thereafter, you're then going to be paying $220 more per year. And you know, if you're 42 years old and you're a very successful physician making $500,000 a year or more or less, hopefully $220 doesn't impact your lifestyle. And if it does, chances are there's bigger issues than this policy. So as I said before, it doesn't matter how you are paying for the policy. If God forbid you need to collect, it just it's a function of whatever your goals and objectives are as to how you pay for this policy. I want to thank everybody for logging on to our webinar on disability insurance. And hopefully it has provided you with the tools necessary to make an informed decision when the time is right to secure a policy. If you would like to block out some time to discuss your situation, please go ahead to www.pgy1.com, and we have a little questionnaire. It'll take you a minute or two to fill out, and then we can discuss your situation and work up some models and figure out what makes sense for you. And if you want to get the process started to secure a policy, feel free to go to disabilityquotes.com/Weinberg, and we have a secure online portal with an online application, and we can get the process started that way. So I want to thank everybody for logging on to our webinar, and have a great day, and feel free to reach out if you want to talk.